In today's video, we discuss how to make sure that your trades make sense for the current market conditions. We will also discuss how to spot when the market has actually changed. One of the biggest causes of traders struggling, even experienced ones, are their trades not matching the current market conditions. So stick around. Before we get into today's topic, I want to remind you we're running a free 2-hour workshop where I spend 30 minutes discussing our proprietary techniques where we select the best risk-reward in-play stocks each and every trading day. Check out the free workshop, click on the link above. It won't take you away from this video. And in addition to our proprietary stock selection process, we will give you 3 of the best risk-reward trades that are used on our prop desk in New York City. What we're going to talk about now is why it is wrong to be the short the market right now. In December, we had a very, very different market. The market was volatile, the market was trending lower, the market took out multi-month support, and we traded very, very differently. And then, after the market bounced at the end of December and early January, things started to change by the second week of January. And since then, we've had about 7 weeks of different market conditions. And what we've seen on our desk, many traders struggling. And the primary reason that the traders are struggling, who have been since mid-January, is not moving away from as many market short setups or looking for that bigger pullback in the market. And so it's very important to recognize when the market changes, when you're in a low volatility, strong uptrending market, to focus on market stocks on the long side, to focus more on in-play names. And one of the built-in things we have for current market conditions in terms of being able to take advantage is we do focus on in-play names. And the one great thing about in-play names is they have a strong catalyst. So to a certain extent, they're going to do their own thing regardless of market conditions. The positive of trading in-play names is that you're going to get negative catalysts and positive catalysts. And even in a low volatility, strong uptrending market, stocks that have negative catalysts will be very good shorts for 2, 3, 4 days before they find a base and start moving higher again. You know, off the top of my head, Netflix following the report of their earnings, that was a good short for 2, 3 days after earnings. Nvidia, after the reported earnings, gapped higher, but then was a good short for a few days. So even in a strong market like this, what we're talking about is not being short the market overall, not making large bets on short the SPYs or IWM or the Qs or whatever the case may be, however you make your short trades, or just trading market trades overall, maybe high beta names, high volatility names like Google, Amazon, etc. So what I want to do is walk you through some of the things I look at to determine what are the current market conditions. We're going to look at volatility, we're going to look at trend, we're going to look at how to spot changes in those things, and then also over a certain amount of time when you should draw a new conclusion. Has the market changed? Are we in a stronger market now or are we in a weaker market now? So first thing we want to do is look at the SPY chart, the daily chart from the last couple of months. And so what you can see very clearly on the left side of that chart is December. We came off very hard in early December into what had been multi-month support, 260. We took that out, and so everyone at that point was thinking, we want to be short the market. From October to early December, we've been between 260 and 280, been pretty good volatility, and when that broke, people piled in on the short side. Now, were people expecting the market to drop 10% over the next week? Probably not. When that happened, basically the chatter on our desk, the way that we did our morning meeting was volatility. Trade the market ETFs, trade the volatility ETFs like the VXX, the UVXY, the levered market ETFs, etc. When the market is in play, we move away from the individual names with catalysts and trade the market overall. And so you can see that, and it got very overextended to the downside, got very vertical. Vertical trends can't last in either direction. And so in late December, December 23rd, 24th, we started looking for a bounce. And at that point, our expectation was we're going to get a bounce. Maybe that down move from 260 to 235, maybe we'll raise half of it to 3/4 of it. And after we get that bounce, we'll look for the market to roll over again. And if it doesn't roll over, we'll look to see, does the market change into an uptrending market? And I want to be really clear about this. When the market went down from 260 to 235, I was looking for a bounce, $15, $20 bounce in the SPYs. I wasn't thinking, oh, the market's going to bounce, volatility is going to compress, we're going to trend up for the next 2 months. That was not the thought process, that was not the percentage odds. What I did here was circle for you on this daily chart when I started thinking about, wait a second, we bounced, and now the market's doing some things. Maybe we're just going to trend higher. So the first big circle is the volatility, the straight down, the big up, the kind of the first consolidation we saw with big intraday ranges over 1% intraday. That was pretty normal, that was expected. Then what we had was in the second week of January, we had a gap up, I think probably above 255, just looking at the chart there. And we spent the next 4 or 5 days just really compressed. And you can see that by how I circled the area there. And so the first thing I want to look at for change in market conditions is expanding volatility or contracting volatility. And so in December, we had expanding volatility, which was a different type of market. But then in the second week of January, we had contracting volatility. So at that point, I said the burden has now shifted to the sellers again to show that we can break to the downside. And you can see after about a week of consolidation, we broke to the upside. What was important about that break to the upside was what did we get above? We got above that bottom blue line. That is where the market broke down from. So we had a great level to know, hey, if we can stay above where the market broke down from in December, buyers are still in control. And what we're going to look at now is, do we stay above that level? Does volatility continue to stay low? And do we start to make higher lows and perhaps take out the next resistance area? And that was my mindset at this point. And again, at this point, I'm thinking buyers are in control. I'm not going to pile in on the short side. But I wasn't by any means thinking at this point we're going to go back up to 280 where we've been resisting from the beginning of October until early December. But I'm thinking buyers are in control. Let's see what happens at the next resistance area. How does the market react? But at this point, it was very important for traders to understand that just piling in on the short side, hitting market stocks that were down 1% or 2% on the day and getting short, these trades didn't make sense anymore. When the market's really volatile and a stock is gapping down and it's down and down and down and you keep on hitting it and playing momentum to the downside, that makes sense. When the market starts to get a strong bid and it's just not rolling over at all, you can still short. You just have to short when things kind of move up into resistance, get a little bit extended, things like that. I'm talking about intraday right now. You can't chase things to the downside. It's not that sort of market. And so I think we do a morning meeting every day. We talk about these things. So by January 10th, we were talking about market conditions changing. Some people adapted. They did okay. Some people didn't adapt. They struggled. I think at this point, most people have kind of now that we're 6-7 weeks into it, they've changed. But ideally, what you want to do is monitor the market each day and do an assessment each day. And after you have 5, 6, 7 data points, basically say you can draw a conclusion that the market's changed and you want to change kind of the way that you're doing things. And this is what's kept me out of trouble. In the past month, maybe I've had one negative day, and there's a bunch of different factors there. Stock selection, understanding things of that nature, but also understanding not to pile in on the short side in these types of market conditions. Kept me out of trouble. When things change, I'm going to give you a heads up. Just like I gave you a heads up in late December that we were looking for a bounce, things we weren't going to zero, we will give you a heads up when market conditions change. So just to finish up on this chart before we move on. We had the first compression after the initial bounce. We had another compression above 260, really tight. And then finally, now we're really tight just below 280. Those are the market conditions. What we can do is we can actually look at the last time we had a pullback in the SPYs. This is, let's determine, first of all, this was a decent short setup. We had run up from 268 or 269 to 273 and change in a couple of days. We'd gotten extended from the 30-minute on the 30-minute, and there was a short trade to be had there. We actually 2 days in a row failed at 273 and a quarter, and then the next day we gapped down. And so I circled that area there. We had a nice down move. We had about a 1% range. That was range expansion. So that's point number one. That was the first piece of data that maybe the market was changing. Now, at this point, did I think the market was changing? No. I figured we had to pull back to the trends. We're probably going to go back up the next few days, take out the high. But at that point, my antennae go up and I say, what do I need to see for this to be a market change that'll change everything that I'm doing? Well, the first thing we have to have is a down move, right? We had a down move, about 1%. We bounced at the end of the day, which is very normal. The next day, if we actually had downside follow through and trended down again, that would be data point number 2. What did we do the next day? No, in the morning we took out the prior day's low and quickly got back above it, and then we bounced. The next day we gapped up a little bit. And then the third point that I highlight for you in this chart right here is 3 days after the big down move, we have already now taken out the high for the year. So kind of those are the 3 points I was looking at. Downtrend on the first day. Second day, what do we do there? Okay, we didn't fail and make a new low. We bounced. Okay, well, the next thing I would want to do at point 3 is maybe we fail again at 273. We fail there, come off hard. Those would be data points that I could look at for maybe the market is changing. And then if we started to have closes below 270 and took out that pullback low at 268, then I'd start to think about volatility expansion, buying puts, more shorts. But none of those things happened. All we had was data point 1, and then everything else went right back to kind of the uptrend. But that's how I'll identify when the market does change. I'm going to go through this process. Look at today's game plan with you and just give you an example of kind of the things that can happen when the market's trending up and has a very, very, very strong bid. So we do these morning game plans every day. Most stocks generally will trade between the support levels we've highlighted and the resistance levels we've highlighted. If a stock actually that has good news gaps higher and right on the open in that first 30 minutes takes out all of our potential resistance, then it's a good candidate for trending for the day. And that's something you just don't generally see that often in a weak market, in a volatile market. You see upside volatility in a strong market. So in Roku, good news, but the guidance was very conservative. You wouldn't really expect it to go crazy to the upside. And what did it do in the first 30 minutes? By 10 o'clock, it had taken out R3 and then started to trend higher and then went up another 10% above R3. Another one, W, in the pre-market was actually trading at our S2. So we had 126 as our support. By the time the market opened, I think it may have even been above R2, and then it ended up trending up another 10%. So both of those stocks took out right on the open our top resistance level and trended up each of them about another 10%. I think W maybe pulled in 5% or so, something like that. But that's just not something you see generally in a weak market. And there was a third name that I didn't even put on the sheet, another very strong one of the market leading stocks, very strong stock, TTD, which did the same thing, took out all of its resistance levels on the open and trended higher. And so those are the sorts of things you see with a market with a very strong bid. So don't short the market right now. Don't look for shorting market plays all of the time. I understand when they get extended to the upside, maybe you nibble, maybe you look at some puts, but it's just not the same. When the market's getting hammered, structurally speaking, we look for bounces and you always get a bounce. You don't always get a bounce that turns into an uptrend or a V bottom, but you always get a bounce. When markets are trending higher, sometimes you don't really get much of a pullback. You move sideways and then you go to the next higher levels, as we've been doing for a couple months now. So that's kind of today's tip. Hope you learned something.